We shall commence this module by understanding the meaning and types of fiscal policy. Fiscal policy is an instrument by which government adjusts its level of spending so as to monitor and influence the economy. It encompasses the taxation and expenditure policies of the government. Fiscal policy, along with the monetary policy by which the RBI influences the nation's money supply, is used in various combinations in an effort to direct the country's economic goals. This means that the governments can influence macroeconomic productivity levels by increasing or decreasing tax levels and public expenditures. This in turn helps to curb inflation, increase employment, and maintain a healthy value of money. When inflation is too strong, the economy may need to slow down. In such a situation, fiscal policy can be used to increase taxes in order to suck money out of the economy. Fiscal policy could also dictate a policy to bring about a decrease in the spending of the government and thereby lead to reduction in the money in circulation. This in turn may decrease the high prices and increase the value of money. The removal of funds from the economy will decrease levels of aggregate demand in the economy, bringing about price stability. Of course, the possible undesirable effects of such a policy in the long run could be sluggish economy and high levels of unemployment. However, the process continues as the government uses its fiscal policy to fine-tune spending and taxation levels with the global smoothing of business cycles. During deflationary periods, taxes are reduced and public expenditures are increased. Thus, we see that the changes in taxation composition and government spending in various sectors are two most important instruments of fiscal policy. These changes can affect the macroeconomic variables amongst others in the economy. The variables to be affected are aggregate demand and the level of economic activity, savings and investment in the economy, and distribution of income. Now, let us discuss types of fiscal policy. Three main types of fiscal policy are: number 1, neutral fiscal policy, which is usually undertaken when economy is in equilibrium. Spending of government is funded fully by the tax revenue and overall budget outcome has a neutral effect on the level of economic activity. Secondly, we have expansionary fiscal policy, which involves government spending exceeding tax revenue and is usually undertaken during recessions. Its objective is to stimulate the economy and create more growth. The government spends more, cuts taxes, or both if it can. The idea is to put more money into consumers' hands, so they spend more. This influences and increases demand, which keeps businesses running and thus adding more jobs. Thirdly, we have contractionary fiscal policy, which occurs when the spending of government is lower than the tax revenue and is usually undertaken to pay off government debt. The objective of this type of fiscal policy is to slow economic growth and thus to curb inflation. In this policy, the taxes are increased and spending is cut. After studying this module, you shall be able to understand the meaning and various types of fiscal policy, learn about the objectives and economic impact of fiscal policy, differentiate between the fiscal and monetary policy, understand the fiscal crisis in India, and comprehend the revenue and expenditure reforms undertaken to deal with the fiscal crisis. Now, we will discuss the objectives and economic impact of fiscal policy. First of all, the objectives of fiscal policy. Firstly, to achieve a desirable price level. The stability of general prices is necessary for economic stability. The stable price levels have a beneficial effect on production, levels of employment and national income. Next is to achieve a desirable consumption level. A desirable consumption level is important for social, economic and political consideration. The factors that can affect consumption, the expenditure and tax policies of the government. Consumption can be affected by fiscal policy to achieve a desirable employment level. The efficient employment level is necessary for political stability and for maximization of production in an economy. Next, fiscal policy is important for increase in capital formation also, because in underdeveloped countries, deficiency of capital is the main reason for underdevelopment. Fiscal policy can divert resources and increase capital which is required for industrial and economic development. Economic impact of fiscal policy. Governments use fiscal policy to influence the level of aggregate demand in the economy in an effort to achieve economic objectives of price stability, full employment and economic growth. According to Keynesian economics, increase in government spending and decrease in tax rates are the best ways for stimulating the aggregate demand. During recession, there is a need to increase aggregate demand. If taxes are lowered, people will have more money to spend or invest. This will lead to economic growth. Moreover, in another plausibility, the government might decide to increase its own spending, say by building more highways. The basic thought is that the additional spending of government leads to creation of jobs and thus lowers the unemployment rates. On the other hand, during the boom period, there is surplus money in the economy which may cause inflation. This money needs to be sucked out. This can be done by increasing the taxes or reducing the government expenditures. Next, we shall discuss fiscal policy and monetary policy. Fiscal policy deals with policy of taxation and government spending and is often administered by an executive under laws of legislature. Monetary policy, on the other hand, deals with the money supply, lending rates and interest rates and is often administered by the central bank. Monetary policy deals with changes in the money supply by the central bank. It may be expansionary, that is increase in money supply, or contractionary, that is decrease in money supply monetary policy. Though there are many tools that can be used, but it primarily relies on the bank rate, that is raising or lowering it. This benchmark rates then guides all interest rates in the economy. With high interest rates, there is contraction of money supply, thereby preventing the inflation. Similarly, with low interest rates, there is expansion of money supply which avoids recession. Various combinations of these two policies are used to influence the economic goals of the country. Now next, let us discuss the fiscal crisis in India. While comparing India's fiscal position with selected federal nations, it has been found that countries like United States, UK, Japan, Nepal, Pakistan, Sri Lanka and South Africa are also highly indebted, as expenditures have remained greater than revenues as a percentage of GDP. From the early 90s till 2007, most countries had deficits, but by 2007, the worldwide situation had improved. However, the financial crisis of 2008-9 led to a remarkable increase in public deficits of many advanced economies. This happened mainly due to the huge stimulus programs in countries around the world. Government bailouts, recapitalizations and takeovers of the banks and other financial institutions also led to increase in the fiscal deficit. Decrease in tax revenues owing to slower growth also made a contribution to the deficits. Recently, the IMF has pointed out at some signs of a turnaround, with reducing government deficits and debt fueled by increased economic activities and growing government revenues in many developed economies. The key fiscal priority the IMF has stated will be bolstering medium-term debt sustainability in developed countries, whereas emerging and low-income economies where the recovery has been faster will be required to tighten fiscal policies accordingly. For the world as a whole, the situation has improved as compared to 80s and 90s. As compared to India, which nonetheless has high deficit at 5.8% of GDP in 2011, countries like United States having deficit of 8.9, UK 8.8, Japan 8.5, Nepal 7.7, Pakistan 7, Sri Lanka 6.8 and South Africa 5.2 have high deficits too. The budgetary position of the central government was under considerable strain during the 80s as far as case of India is concerned. The gross fiscal deficit increased about 5 times during the decade, from 5.5% of GDP in 1980-81 to 7.6% in 1990-91. In absolute terms, the revenue deficits increased by almost 6 times, from 2,037 crores to rupees 18,562 crores in this decade. As a proportion of GDP, the centre's revenue deficit was 1.3% in 1980-81 and had increased to 3.1% in 1990-91. These high deficits were followed by a balance of payments crisis in 1991. The Indian economy was unable to pay off essential imports and hence ran a high deficit and borrowed from external sources to finance those deficits. The country had an unsustainable fiscal deficit of close to 8.5% of gross domestic product. Moreover, inflation was on a rise. The government was on verge of defaulting and the central bank refused new credit. The foreign exchange reserves were reduced to a point that India could barely finance 3 weeks worth of imports. Indian government's immediate response was to airlift national gold reserves as a pledge to the International Monetary Fund in exchange for a loan to cover balance of payment debts. It secured an emergency loan of 2002 billion US dollar. The 1991 crisis saw several reforms initiated by the Prime Minister P.V. Narasimha Rao and the Finance Minister Manmohan Singh that were collectively called liberalization. The reforms were started by simplification and rationalization of the tax system that would cut spending. The reforms also included removal of controls and regulation on the industry, which led to the end of Permit Raj and free rein to entrepreneurs. This opened India to foreign investment. Next, we will discuss the highlights of economic reforms 1991. The roadmap laid out for the fiscal reforms in 1991 stressed on three broad areas. Firstly, tax reforms, both direct and indirect. Secondly, compressing subsidies and budgetary allocation to public sector undertakings. And thirdly, improving the quality of expenditures. The main principle of these measures was to reduce fiscal deficits of the government. This new policy was a crucial step in bringing about the culture of entrepreneurism, which has helped transform the Indian economy into a highly productive economy. This process brought India back on the track, and after that, India's foreign currency reserves have never touched such a low. Post reforms, the fiscal performance in terms of movements in the revenue and gross fiscal deficit may be categorized in four distinct phases, that is, the period of improvement from 1991-92 to 1996-97, the period of worsening from 97-98 to 2001-2, and the period of improvement from 2002-3 and the phase following global financial crisis in 2008. Economic reforms reduced the fiscal deficit to 5.48% in 2000-2001. However, there was no improvement in the revenue deficit. The revenue deficit of 3.93% called for reforms once again, and the Fiscal Responsibility and Budget Management Act was passed in 2003. Now, moving on to discuss the Fiscal Responsibility and Budget Management Act, also known as FRBM Act 2003. The Act was enacted by the Parliament of India to institutionalize financial discipline, reduce India's fiscal deficit, improve macroeconomic management and the overall management of public funds by moving towards a balanced budget. The main objectives of the Act were, firstly, to introduce transparent fiscal management systems in the country, and secondly, to aim for the fiscal stability for India in the long run. Targets and fiscal indicators of the Act were, first of all, in context of revenue deficit, the date of elimination was set as 31st March 2009, which was a postponed date from 31st March 2008, which was given in the original Act. It was targeted that there will be a minimum annual reduction of 0.5% of GDP. In context of fiscal deficit, the ceiling was decided to be 3% of GDP, which was to be achieved by 31st March 2008. The minimum annual reduction expected was 0.3% GDP. There was a steady reduction in both revenue and fiscal deficit after the FRBM Act was passed in 2003. The fiscal deficit relative to GDP declined to 2.5% in 2007-8. Similarly, revenue deficits declined to about 1% in 2007-8. The slowdown in the economy owing to the global financial crisis in 2008-9 resulted in a sharp reversal of the trend. The revenue and fiscal deficits deteriorated to 4.5% and 6% of GDP in 2008-9. However, the economy recovered from this shock in the subsequent years, and in 2010-11 there was a reduction in fiscal and revenue deficits to 4.87 and 3.29% respectively. Let us now discuss the reforms undertaken on the revenue front. First of all, comprehensive tax reforms were implemented in 1985, under which the corporate tax rates were cut, income tax was simplified and lowered for high income groups, and wealth taxes were reduced. The number of tax brackets was reduced from 8 to 4, and the highest income tax rate was brought down to 50%. The wealth tax rate was brought down to 2.5%. Secondly, modified value added tax, also known as MODVAT, was introduced in a phased manner from 1986, which was later converted to Central VAT or CENVAT in 2000-2001. Thirdly, the long-term fiscal policy presented in the Parliament in 1984-85 emphasized the need to reduce customs tariff, have fewer rates and greater uniformity, and reduce and then eventually eliminate quantitative restrictions on imports. Fourthly, the Tax Reform Committee under Professor Raja J. Chalaiya in 1991 recommended a number of reforms on the taxes, which are simplification and rationalization of the direct tax structure, introduction of service tax, reducing the rates of individual and corporate income taxes, customs and excise duties and making it more progressive, broadening of tax base, reducing exemptions and concessions, computerizations and improvement in the quality of tax administration, introduction of permanent account number, that is PAN number, to track monetary transactions. The tax rates were considerably simplified to have 3 slabs, beginning with a rate of 20, 30, 40% in 1992-93, which were later reduced to 10, 20, 30% in 1997-98 and have continued to be so till date, with some changes in the associated tax brackets. The exemption limit remained at 50,000 since 1998-99, but in 2005-06 budget it was raised to rupee 1 lakh. The standard deduction was abolished. In addition, savings in superannuating schemes up to rupee 1 lakh was made deductible from the taxable income. The exemption limit in the budget of 2011-12 was raised to rupees 1,80,000. In the case of corporate taxation, the distinction between closely held and widely held companies was done away, and the tax rates were unified at 40% in 1993-94. In 1997-98, the company rate was brought down to 35%. In the 2005-06 budget, the corporate income tax was reduced to 30% on domestic companies with a surcharge of 10%. Next is minimum alternate tax, MAT, which was introduced in 1997-98 to eliminate zero tax companies. A fringe benefit tax was introduced in 2005-06 to tax the indirect benefits of a wide range of expenses of the economy, including entertainment, conference, employee welfare, sales promotion, including publicity, conveyance, tour and travel, including foreign travel expense and use of telephone. The most important reform in the tax administration was an expansion of the scope of the tax deduction at source, also known as TDS. the Direct Tax Code DTC for direct taxes and the Goods and Services Tax, that is GST, in case of indirect taxes are a part of the tax reforms that focus on evolving an efficient and harmonized consumption tax system in the country. Next, we shall discuss the reforms undertaken on the expenditure front. In 1999-2000, the government decided to subject all planned and non-planned schemes to zero-based budgeting. ZBB, that is zero-based budgeting, is the construction of a budget without reference to past expenditures. It is based on a fundamental reappraisal of purposes, methods and resources. While the program of privatization or disinvestment in central public sector undertakings remained a low key throughout the 90s, it started to gather momentum from 2001 to give a greater thirst to the process of disinvestments. A separate department was created. From the year 2002-03 onwards, fresh recruitments were restricted to 1% of total civilian staff strength of the government. A decision to reform the pension system for the government employees by introducing a pay-as-you-go as opposite to the existing fully funded system was also taken. To carry the process of reducing the growth in non-development expenditures, the government set up an Expenditure Reform Commission in February 2000. The main terms of reference of the commission were: firstly, to suggest a roadmap for reducing the functions, activities and administrative expenditures of the central government. Secondly, to review the framework of all subsidies, both explicit and implicit, for maximizing their impact on the target population and to minimize the cost. Thirdly, to review the framework for determination of user charges of departmental and commercial activities and suggest an effective strategy for cost recovery. Fourthly, to review the adequacy of staff under the central government ministries and attached offices, etc. Fifthly, to review the process for setting up of government funded autonomous institutions. And sixthly, to consider any other relevant issue concerning expenditures. Expenditure Reform Commission covered aspects like buffer stock operation and rationalization of fertilizer subsidies, optimizing government staff strengths with a ban on the creation of new posts for 2 years, the introduction of VRS, that is voluntary retirement scheme, and deployment of a surplus staff in various government departments and autonomous institutions funded by government budgetary support. Now, in the end, let us summarize what we have learned in this module. Fiscal policy, which encompasses the taxation and expenditure policies of the government, is an instrument by which government adjusts its level of spending in order to monitor and influence the economy. The two main instruments of fiscal policy are taxation and government spending in various sectors. Neutral fiscal policy is the policy undertaken when the economy is in equilibrium. Spending of the government is funded fully by the tax revenue and overall budget outcome has a neutral effect on the level of economic activity. Expansionary fiscal policy involves government spending exceeding the tax revenue and is usually undertaken during recessions. Its objective is to stimulate the economy and create more growth. Contractionary fiscal policy occurs when government spending is lower than tax revenue and is usually undertaken to pay off government debt. The objective of this type of fiscal policy is to slow economic growth so as to curb inflation. Fiscal policy can be distinguished from monetary policy. Fiscal policy refers to the taxation and government spending and is often administered by an executive under laws of a legislature, whereas monetary policy deals with the money supply, lending rates and interest rates and is often administered by a central bank. From the early 90s to 2007, most countries had deficits, but by 2007 the worldwide situation has improved. However, the financial crisis of 2008-9 led to a remarkable increase in the public deficits of many advanced economies. It is not only in India that the fiscal deficit have been high at 5.8% of GDP in 2011. Countries like United States, UK, Japan, Nepal, Pakistan, Sri Lanka and South Africa are also highly indebted. The gross fiscal deficit increased about 5 times during the decade. In Indian context, the gross fiscal deficit increased about 5 times during the decade from 5.5% of GDP in 1980-81 to 7.6% in 1990-91. There was a steady reduction in both revenue and fiscal deficit after the FRBM Act was passed in 2003. However, the slowdown in the economy owing to the global financial crisis in 2008-9 resulted in the sharp reversal of the trend.